Everyone talks about building wealth through the stock market. But what if I told you there's another asset that's outperformed it by more than 5x? We're talking about the S&P 500 versus Bitcoin. One represents the bedrock of traditional finance, the other, a digital frontier. But the real question isn't just which one is better. It's about how you can strategically combine them. The secret isn't about timing the market perfectly. It's about consistency. Let's start with the champion of traditional investing, the S&P 500. This isn't just one stock. It's a basket of the 500 largest, most established companies in the United States. Think of the household names that define our economy. It's the benchmark against which almost all other investments are measured. Historically, it has delivered average annual returns of around 10 to 12% over the very long term. It's the definition of slow and steady, making millionaires through decades of consistent compounding and reinvested dividends. It's built on a foundation of real-world earnings and a century-long track record. But that stability comes at a cost. Growth is measured in years, not months, and your gains can be quietly eroded by inflation. Now, let's look at the challenger, Bitcoin. Since its creation, it has posted staggering average annual returns, dwarfing almost every other asset class. But this incredible performance comes with a wild ride. Bitcoin is famously volatile. It experiences dramatic crashes, sometimes losing over 50% of its value in a matter of months. Yet, historically, it has always rebounded, eventually reaching new all-time highs. Its growth doesn't happen in a straight line. It occurs in explosive cyclical waves, often tied to its halving events, which algorithmically reduce its new supply every 4 years. This creates a dynamic of digital scarcity and speculation, unlike anything in traditional markets. So how do you navigate these two completely different worlds? Do you try to buy the S&P 500 at the bottom and sell at the top? Do you try to time Bitcoin's parabolic runs? The data shows that trying to time the market is a losing game for most people. A more powerful and less stressful strategy is dollar-cost averaging, or DCA. The concept is simple. You invest a fixed amount of money at regular intervals, say $100 every month, regardless of the asset's price. When the price is low, your fixed amount buys more shares or coins. When the price is high, it buys fewer. This approach removes emotion from the equation and smooths out your average entry price over time, reducing the risk of investing a large sum right before a market crash. It's a discipline, not a get-rich-quick scheme. Let's make this practical. Imagine you have $500 a month to invest. A common approach is to create a blended portfolio. For a more conservative strategy, you might adopt an 80-20 split. That's $400 into a low-cost S&P 500 index fund and $100 into Bitcoin each month. If you have a higher risk tolerance and a longer time horizon, you might choose a 60-40 split, $300 for the S&P 500 and $200 for Bitcoin. The key is automation. Set up automatic transfers on the first of every month. This enforces discipline and ensures you're consistently building your positions without having to second-guess yourself. Let's run a hypothetical backtest. If you had followed an 80-20 DCA strategy over the last 5 years, your S&P 500 allocation would have provided a stable foundation, steadily growing and cushioning your portfolio during crypto winters. Meanwhile, your Bitcoin allocation, despite its gut-wrenching drops, would have been the primary driver of your portfolio's outsized growth. The blended portfolio would have significantly outperformed the S&P 500 alone, but with far less volatility than a 100% Bitcoin portfolio. This leads to another key discipline: rebalancing. Let's say after a huge Bitcoin rally, your portfolio is now 70% S&P 500 and 30% Bitcoin, far from your 80-20 target. Rebalancing means you'd sell some Bitcoin to take profits and use the proceeds to buy more S&P 500, bringing you back to your goal. It's a systematic way to sell high and buy low, forcing you to take gains and reinvest in the underperforming asset. Getting started is simpler than you think. For stock exposure, you can open an account with any major brokerage and set up recurring investments into a low-fee S&P 500 ETF. For Bitcoin, use a well-known, reputable cryptocurrency exchange that also allows for automated buys. But always remember the risks. Bitcoin's value can be swayed by regulatory news, technological developments, and wild shifts in market sentiment. The S&P 500, while more stable, is not immune to recessions, geopolitical events, and as we mentioned, the slow erosion of purchasing power from inflation. That's why this strategy is for the long term, and you should always have a separate emergency fund to cover unexpected life events. Please remember, this content is for educational purposes and should not be considered financial advice. Your personal financial situation and risk tolerance are unique. So, what's the smarter move? It's not about choosing one over the other. It's about building a disciplined, automated system that leverages the strengths of both. By blending the stability of the S&P 500 with a measured slice of Bitcoin's high-growth potential, you create a balanced engine for wealth creation. Small, regular steps, taken consistently over time, can lead to big long-term outcomes. Because in today's world, a balanced, disciplined approach is what truly builds lasting wealth.